Understanding company financials. Key financial statements. To gauge a company's financial health, focus on its core reports: the balance sheet, income statement, cash flow statement, and the accompanying annual report. Together, these documents reveal what the company owns and owes, how it earns and spends money, and how cash actually moves through the business. Balance sheet, income statement, cash flow statement, annual report. Balance sheet. To work the balance sheet, you systematically classify and analyze its three core sections: assets, liabilities, and shareholders' equity, then apply vertical, common size, and horizontal, trend analyses before calculating key ratios to assess liquidity, leverage, and efficiency. Understand the structure. The balance sheet is split into two sides that must always balance: assets equals liabilities plus shareholders' equity. Each side breaks down into current, due or convertible within 1 year, and non-current, long-term, items. Current assets include cash, receivables, and inventory. Non-current assets cover property, plant, and equipment, PP&E, and intangibles. Current liabilities encompass payables and short-term debt, while non-current liabilities consist of long-term loans and deferred obligations. Perform vertical analysis. Convert every line item into a percentage of its total side to reveal composition changes over time. Asset items divided by total assets. Liability and equity items divided by total liabilities plus total equity. Comparing these percentages across reporting periods highlights shifts in capital allocation and funding sources. Perform horizontal analysis. Measure dollar and percentage changes for each line item across multiple periods to spot trends. 1. Change equals current period, prior period. 2. Growth rate equals change divided by prior period. Look for significant swings, for example, a sudden buildup of receivables or spike in payables, that warrant deeper investigation. Calculate key ratios. Translate raw balances into diagnostic metrics. Liquidity, current ratio equals current assets divided by current liabilities. Solvency, debt to equity ratio equals total liabilities divided by shareholders' equity. Efficiency, inventory turnover equals cost of goods sold divided by average inventory. Benchmark these against industry peers to interpret whether the company is too leveraged, undercapitalized, or inefficient. Integrate qualitative context. Numbers alone can mislead. Always read footnotes and management discussion for accounting policies, contingent liabilities, one-off transactions, or off-balance sheet items. Overlay industry trends and macroeconomic factors to enrich your interpretation. Once you're fluent in raw analysis, advance to financial modeling. Forecast future balance sheets and link them to projected income statements and cash flows. Run sensitivity and scenario analyses to test how changes in revenue growth, working capital assumptions, or financing mix affect financial health. Dive into specialized topics like covenant compliance testing, off-balance sheet leases, and working capital optimization to sharpen your toolkit. Income statement. To work the income statement, you assemble its core line items: revenue, cost of goods sold, operating expenses, non-operating items, and taxes. Then apply vertical, common size, and horizontal, trend analyses, calculate key profitability metrics, interpret results in context, and use those insights to forecast future performance. Understand the structure. The income statement begins with total revenue and deducts cost of goods sold to arrive at gross profit. From there, operating expenses, SG&A, R&D, depreciation, are subtracted to calculate operating income. You then account for other income or expenses, interest, investment gains, losses, before subtracting taxes to determine net income. Perform vertical analysis. Convert each line item into a percentage of total revenue to see how sales dollars are consumed or retained, gross profit divided by revenue, operating income divided by revenue, net income divided by revenue. Comparing these margins across periods or peers highlights shifts in cost structure and profitability. Perform horizontal analysis. Measure changes in absolute dollars and percentage terms for each line item over multiple periods. Change equals current period, prior period. Percent change equals change divided by prior period. This flags unusual swings, like a spike in marketing spend or a slump in sales, that merit deeper investigation. Calculate key profitability metrics. Translate raw figures into ratios that gauge efficiency and performance. Gross margin equals gross profit divided by revenue. Operating margin equals operating income divided by revenue. Net margin equals net income divided by revenue. EBITDA margin equals operating income plus depreciation plus amortization, divided by revenue. Benchmarking these ratios against industry standards helps assess competitive positioning. Interpret and contextualize. Numbers alone can mislead. Review footnotes and management discussion to identify one-off items, asset sales, restructuring charges, and changes in accounting policies. Layer in insights on seasonality, competitive dynamics, and macroeconomic trends to understand underlying drivers. Use for forecasting. Build a pro forma income statement by projecting revenue growth rates and assuming stable or improving margins. Link it to a forecasted balance sheet and cash flow statement, then run scenario analyses, best, base, and worst cases, to test sensitivity and inform strategic decisions. Cash flow statement. To work a cash flow statement, classify cash movements into operating, investing, and financing activities, perform vertical and horizontal analyses, calculate key liquidity and cash-based metrics, interpret cash generation and usage in context, and leverage those insights to forecast future cash needs and support valuation models. Understand the structure. The cash flow statement is divided into 3 sections. Operating activities, cash from core business operations, investing activities, cash used for or generated by asset purchases and sales, and financing activities, cash from debt and equity transactions. It can be prepared using the direct method, listing actual cash receipts and payments, or the indirect method, which starts with net income and adjusts for non-cash items and changes in working capital. Perform vertical analysis. Express each section as a percentage of total cash inflows or of revenue to gauge the composition of cash sources and users. This common size view highlights whether a growing share of cash is tied up in operations, being reinvested in assets, or used for financing. Perform horizontal analysis. Track dollar and percentage changes in operating, investing, and financing cash flows across periods. Change equals current period, prior period. Percent change equals change divided by prior period. Spot significant swings, such as surging capex or a jump in debt repayment, that warrant further investigation. Calculate key metrics. Derive diagnostic measures to assess liquidity and financial health. Free cash flow equals operating cash flow, capital expenditures. Operating cash flow ratio equals operating cash flow divided by current liabilities. Cash conversion cycle equals days inventory outstanding plus days sales outstanding, days payable outstanding. These indicators reveal the company's ability to generate cash, cover obligations, and reinvest for growth. Interpret and contextualize. Compare operating cash flow to net income. Ideally, cash from operations should routinely exceed net income, signaling strong cash generation. Negative investing cash flow often reflects strategic growth investments, while financing cash flow patterns show whether the company is raising capital or returning it to shareholders. Always review footnotes for one-off cash events like asset sales or debt restructuring. Use for forecasting. Build a pro forma cash flow statement by projecting each activity line based on revenue growth, capex plans, and financing strategy. Integrate your forecast into discounted cash flow, DCF, models to estimate enterprise value, and run scenario analyses, e.g., conservative, base, aggressive, to understand cash flow sensitivities and guide strategic decisions. To work an annual report, you start by reviewing the company overview and strategic highlights, then analyze the financial statements, dig into MD&A and footnotes, apply ratio and trend analyses, layer in qualitative context, and leverage those insights for forecasting and valuation. Grasp the business overview. Company profile, what the business does and its market positioning. Strategic priorities, mission, long-term goals, and key initiatives. Material events, acquisitions, launches, regulatory shifts. Analyze the financial statements. Income statement, revenue trends, expense drivers, net profit. Balance sheet, asset mix, capital structure, liquidity position. Cash flow statement, cash generation, investment outlays, financing flows. Read management discussion and analysis, MD&A, performance commentary, management's take on drivers and setbacks. Forward outlook, guidance, growth assumptions, planned investments. Risk factors, operational, financial, regulatory challenges. Scrutinize the footnotes. Accounting policies, revenue recognition, depreciation methods, leases. Contingencies and commitments, lawsuits, guarantees, off-balance sheet items. Segment disclosures. Performance by division or geography. Perform quantitative analyses. Vertical, common size. Express each line as a percentage of revenue or assets. Horizontal, trend. Measure year-over-year changes in dollars and percentages. Key ratios. Liquidity, current ratio, profitability, ROE, margins, leverage, debt to equity, efficiency, turnover ratios. Integrate qualitative insights. Tone and transparency. Is management candid or overly optimistic? Governance and leadership changes. Board composition, executive turnover. ESG and sustainability initiatives. Commitments and performance metrics. Apply findings to forecasting and valuation. Build pro forma financials using historical trends and management guidance. Conduct discounted cash flow, DCF, or multiples-based valuations. Run scenario analyses, base, upside, downside, to test sensitivities. By systematically combining quantitative metrics with the story behind the numbers, you'll extract a clear, actionable view of the company's performance, risks, and future prospects. Balance sheet, snapshot of position. A balance sheet shows assets, liabilities, and owner's equity at a specific date. Assets are resources with quantifiable value, cash, inventory, equipment. Liabilities are obligations owed to others, loans, payables. Owner's equity equals assets minus liabilities, what shareholders truly own. Income statement, profitability over time. The income statement, profit and loss statement, tracks revenues and expenses over a period. Revenue, total sales or income generated. Expenses, costs like salaries, rent, materials. Net profit, what remains after subtracting expenses from revenue. A positive net profit indicates the company is earning more than it spends. Cash flow statement, actual cash movements. This report undoes accrual accounting, showing real cash inflows and outflows. Operating cash flow, cash from core business activities. Investing cash flow, cash used for acquisitions or capital expenditures. Financing cash flow, cash from debt or equity transactions. Analyzing these sections helps you see whether profits translate into actual liquidity. Putting it all together, analysis and ratios. Once you've read each statement, use ratio analysis and trend comparisons to deepen your insight. Liquidity ratios, e.g., current ratio, assess short-term solvency. Profitability ratios, e.g., return on equity, measure efficiency in generating profit. Leverage ratios, e.g., debt to equity, show the extent of debt financing. Efficiency ratios, e.g., inventory turnover, reveal how well assets are managed. Compare ratios over multiple periods and against industry peers to spot strengths, weaknesses, and emerging trends. Beyond the numbers, qualitative insights. Financials tell a powerful story, but consider context. Footnotes and management discussion in annual reports reveal accounting policies, contingent liabilities, and strategic plans. Industry trends, competitive landscape, and macroeconomic factors can affect future performance. One-off events, asset sales, restructuring charges, may skew single-period results. By blending quantitative ratios with qualitative context, you'll develop a richer, more reliable understanding of any company's finances. Like and subscribe. Reference Tube.